It's a big 24 hours for global interest rates, with the FOMC expected to guide on a September rate cut tomorrow morning. And expectations the Bank of Japan will hike today. Markets also looking ahead to today's inflation data in Australia and whether it might force the RBA to raise rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand's agriculture economist Susan Kilsby unpacks the effects of weak consumer confidence in China on New Zealand's main exports of dairy, beef and lamb.
They're looking to just keep things in check, and what that really means is they are spending more on sort of more of the traditional foods and staying away from some of these higher priced foods.
But first in 5 and 5 with ANZ. US tech stocks are weak, with the S&P 500 down 0.8% at 4 a.m. Sydney-Melbourne time. Yields on US Treasuries are down 1 to 2 basis points. That's ahead of a huge 24 hours for global interest rates, with the Bank of Japan and the FOMC in the US set to make policy decisions. In Japan, ANZ senior international economist Tom Kenny says markets see a 50% chance of a hike. He expects a 15 basis point hike to 0.25%. That's because several inflation measures, watched closely by the Bank of Japan, are running at their fastest rates since the 1990s.
There is a virtuous cycle occurring between wages and inflation that can sustain overall inflation at 2%. We also think these developments will lead the Bank of Japan to slightly upgrade its inflation forecast at this meeting. If it doesn't, at a minimum, we would expect them to be more wary of upside risks to inflation. Now, Governor Ueda has previously outlined 2 scenarios in which the Bank of Japan might raise rates. Firstly, if the central bank revives up its price outlook, or secondly, the upside risks to inflation become greater. We think that either one or both scenarios could be used by the Bank of Japan to justify a rate hike at its meeting today.
Number 2. Then early tomorrow morning, it's the FOMC's turn, with a decision at 4 a.m. Sydney-Melbourne time. A hold is expected, but markets will be watching for clues on what it will take for the Fed to start cutting rates in September.
We expect Chair Powell to face several questions around the labour market and the timing of rate cuts. On the labour market, we expect Powell to be asked what developments here might trigger a rate cut. This is a valid question given that the unemployment rate has been edging higher and that monetary policy is becoming more restrictive as the real policy rate continues to rise. We doubt that Powell will say anything specific and expect him to continue to reiterate that it would have to be something material. So far, job layoffs remain low, suggesting that the labour market remains reasonably resilient, and thus, in our view, the FOMC gaining greater confidence in inflation returning 2% will be the trigger for rate cuts.
Number 3. Australia's June quarter CPI inflation figures will be closely watched today for clues on whether the RBA might need to hike interest rates next month. ANZ senior economist Catherine Birch is forecasting headline annual inflation of 3.9%, that's up from 3.6% in the first quarter, and trimmed mean CPI inflation, also of 3.9%, but that's down from 4% the previous quarter. The RBA is forecasting 3.8% for both, and if there's a miss, all eyes will be on how big it is following recent strong jobs data in Australia.
Most forecasters are, like us, expecting the RBA to be on hold at 4.35% at their meeting the following week. But there are some risks around that, particularly if we see, say, a 4.1 or a 4.2 on the trimmed mean measure. That would be very challenging for the RBA. And we do acknowledge that there is a risk that they hike in August if the CPI print is stronger than we expect, and also if the staff in their forecasts revise up the outlook for economic activity and the labour market.
Number 4. The ANZ Roy Morgan survey of Australian consumer confidence found it dipped slightly last week, but held on to most of the previous week's gains. It's up 4.6 points over the last fortnight. ANZ economist Maddie Dung says that follows stage 3 tax cuts, showing through into people's pay packets.
It'll be interesting to see whether this upward momentum in consumer confidence is maintained. If we see that CPI comes in stronger than expected and there's increased talk about the potential for the RBA to increase rates at its August meeting, that would likely put some pressure on consumer confidence. And of course, if we do see the RBA decide to hike, that's likely to eradicate any upward momentum that we've seen in consumer confidence over the last fortnight.
Number 5. Australian building approvals fell 6.5% in June from May. That was double the market's expectation due to a 19.7% drop in the volatile unit approvals category. Here's ANZ senior economist Blair Chapman.
Recently we've seen really strong house prices or house price growth in Perth and Brisbane, and a bit weaker in Melbourne and New South Wales, and this data sort of of supports the idea that house prices aren't really strong enough to encourage developers in New South Wales. So we actually saw a fair sort of pullback in New South Wales with a sort of decline of 19% in New South Wales. We know that there's sort of material and labour shortages on the other side of it. So, if the prices that builders and developers can get isn't growing, yet material and labour costs are, then we do tend to see this sort of decline in approvals.
Blair Chapman there. Now, in our bonus deep dive interview, ANZ agricultural economist Susan Kilsby looks at how weakening consumer confidence in China is affecting demand for New Zealand's important primary exports.
So China's consumers really just not as confident as they once were. So they're not as confident about China's economic situation. They're less confident about their own jobs, and they're less confident about their investments, particularly investments that they may have made in the property sector. So they're really just no longer quite so gung-ho on their spending. They're looking to just keep things in check. And what that really means is they are spending more on sort of more of the traditional foods and staying away from some of these higher priced foods.
Could you tell us a bit more about how New Zealand's sheep meat, beef and lamb and dairy is consumed there as a bit more of a luxury item, perhaps something that's a bit special?
Red meat tends to be a lot more expensive than pork and chicken and fish, which sort of have been the traditional sources of protein for Chinese consumers. What we did see a few years back was a bit of a surge in demand for products like beef and mutton, and that sort of coincided with when they had their own challenges with their own pork production, which got the pork and pig industry got decimated when the African swine flu came through. So that was it became an opportunity for consumers to branch out into other forms of protein. So we did see, an increased demand for those products at that time, but that sort of reversed off in the last couple of years, and now we're seeing much lower prices from that market as demand has sort of keyed back, and very few other markets that are looking particularly for those mutton and lamb products that we have traditionally sold into China. In terms of beef exports, China's really ramped up its beef imports in recent years, and New Zealand only supplies a very small portion of that market. We're only supplying about 8% of the total beef that China's importing. Most of their beef comes from other markets like Brazil and Argentina and the United States. So we're a small player in what has been quite a quickly growing market. And, in terms of prices for farmers here in New Zealand, our beef prices, they haven't been impacted as much by the sort of slowdown in China. One, because we're only a small part of that big market, and also at the same time we've seen really strong demand for our beef from the US market, so that sort of offsets some of this weakness that we've seen in the China market. In terms of our dairy products, a lot of the product that we sell into that market either gets reconstituted into liquid milk or yogurt type products. A lot of it also gets used in manufacturing other products, and a lot of the fats, the butter and AMF go into products like pastries and sweets and ice creams and all sorts of goods that are produced within China as well. So they do tend to be sort of high-end goods, so not necessarily what you consume every day. So those products have been impacted a little by this slowing down of consumer demand and consumer confidence. And then a lot of our dairy products also go into the food service sector. So that sector's been going quite well still, as we've sort of been providing products that chefs can work with in that market. But again, people aren't sort of spending quite what they once were on in these sorts of markets.
Susan Kilsby there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, July the 31st. Look out tomorrow for that big FOMC decision hot off the Fed's email service and reaction to today's Bank of Japan decision, as well as what the Australian inflation figures mean for interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.